Hello to everyone. Today, as on November 4, 2024, I am going to discuss about the monetary policy decision announced by the Central Bank of Pakistan. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel that is Financial Reality. Factor influence State Bank of Pakistan policy rate. Monetary Policy Committee observed the following developments since last meeting that was held on September 12, 2024. First of all, IMF board approved Pakistan new extended fund facility program which has reduced uncertainty and improved the prospect for the realization of the planned external inflow. As a result of surveys conducted in October showed an improvement in confidence and a reduction in inflation expectation of both consumer and businesses. Secondary market yield on government securities and Khyber has declined substantially. Tax collection during the first 4 months of financial year 25 fell short of target. Global oil prices have exhibited significant volatility amidst escalating geographical tension. Prices of metals and agriculture products have increased notably. Committee viewed the current monetary policy sustain as appropriate to achieve the objective of stability on a durable basis by maintaining inflation within 5 to 7% target range. This will also support microeconomic stability and help achieve economic growth on sustainable basis. Now, first of all, we are going to discuss the real sector. The latest data showed a gradual pickup in the economic activity. Now, what are the bases? The initial estimates of major kharif crops turned out better than the monetary policy's earlier expectation, higher than targeted estimates of rice, sugarcane production have more than offset the estimated shortfall in maize and cotton output. So here you can see the sugarcane and the rice offset the shortfall of maize and cotton output. Pace of industrial activity is going further. Projections, in particular textile, food, automobile, and allied industries, have recorded significant growth during July and August 2024, which is expected to gain further momentum in the coming month. So here we can see the main three areas that include textile, food, and automobile, and their allied industries. So there are expectations that in the coming year, they will grow as they have shown the growth in July and the August. Assessment is supported by increasing import of raw material and machinery, improving the business confidence and easing the financial condition. Now here, one indicator that includes import of raw material and machinery. So both of them are revenue generating products. If in real sense there is increase in both these two areas, so it will also bring certain significant output in the shape of economic activity. Better prospects of commodity producing sectors and easing the inflationary pressures are also expected to support services sector. Monetary Policy Committee expects real GDP growth in financial year 25 to be better than its early assessment, while remaining in the range of 2.5 to 3.5%. External sector, first of all, we are going to discuss about the current account. Posted a surplus for the second consecutive month in September 2024 and lowering the cumulative deficit to $98 billion in first quarter for the financial year 25. It's mean from July to September, despite a substantial increase in imports, robust workers' remittance, and higher export help contain the deficit. So here we have three factors. First of all, increase in the import. Secondly, boost the workers' remittances, that is a part of inflow, and higher export, it is also a part of inflow. So you can say the deficit between import and on the other side, worker remittances and exports is narrowed down, and that also decreased the deficit. On the financing side, foreign investment record a slight uptick in September. These developments, along with the receipt of the first tranche under the IMF program, helped in the further build-up of State Bank of Pakistan foreign reserves to $11.2 billion as on October 25, 2024. Going forward, imports are expected to pick up further amidst an increase in the economic activity. The Monetary Policy Committee non-athletes assessed that the relatively higher worker remittance and the export will help keep the current account deficit within the projected range of 0 to 1% of GDP. Together with the realization of planned official inflows, is expected to increase the State Bank of Pakistan's foreign exchange reserve to around $13 billion by June 25. Fiscal sector. During first quarter for the financial year 25, the fiscal and the primary balance posted surplus of 1.4% and 2.4% of GDP respectively. This improvement is mainly explained by record high State Bank of Pakistan profit, which substantially increased the non-tax revenue. On the other side, FBR tax collection fell short of target during July to October. This implies that achieving the financial year 25 tax target will require significantly higher growth going forward. Expenditure side, lower interest payments are creating a sizable fiscal space that would help keep a check on the overall fiscal deficit. Meeting the targeted primary balance, however, would be challenging. The Monetary Policy Committee emphasized the importance of continuous fiscal consolidation to support microeconomic stability and reiterated the need for the fiscal reform focusing on broadening the tax base and increasing the losses. So here we have to see about the microeconomic stability and need to bring the fiscal reform. It may be in the shape of further tax burden or to enforce the tax from the people who should pay or are not paying. So these types of the measure can be taken in the coming time. Inflation outlook. Since the last monetary policy meeting, inflation is significantly and fell close to its medium-term target range. The headline inflation year to year dropped to 9.5% in September and 7.2% in October from 9.6% in August. Besides, contained demand, improved domestic supply of the key food commodities, bending global oil prices, favorable base effect accelerated the pace of disinflation in the recent months. MPC noted that continuation of these factors may bring inflation further down in the next few months. Moreover, underlying inflationary pressure continue to ease as indicated by a relatively gradual decline in core inflation and moderation in inflation expectation. Considering these developments, the MPC now expect the average inflation for financial year 25 to be significantly lower than its previous forecasted range of 11.5 to 13.5%. The committee also says that this outlook is subject to multiple risks, such as escalation in the Middle East conflict that is ongoing, reconnaissance of the food inflation pressure, a dock adjustment in administrative price, and implementation of contingency taxation measures to meet the shortfall in the revenue. These are the big challenges that can turn the position to any side, but we are hopeful that we will be able to meet our targets, hopefully. In the meeting held on today, November 4, 2024, in which the committee decided to reduce the policy rate by 250 basis points from 17.5% to 15% based on the factors we have discussed. Definitely decrease in these policy rate, it will bring or it will increase the business activity more because higher rate attract the investors to invest within the fixed investments, but lower rate shift the money from the fixed investment to the businesses, and that definitely boosts the economic activity within the country. So see you again very soon with the upcoming video of banking and finance related upcoming topics. Thank you very much for watching my video.